how trading works.
Hello! You are here because you want to learn about how trading works, and I am here to share that information with you. Before we upskill ourselves, grab a pen, notepad, and some water. Right, let's begin.
The history of trading.
Trading dates back to the 1600s, where the Dutch East India Company employed hundreds of ships to transport gold, silk, porcelain, and spices around the world. Funding was derived by splitting shares of the company, making them available to the general public to receive a portion of the profits as the company grew. Multiple companies have replicated this process to kickstart their businesses and have received funding from willing investors. However, it's important to note that not all investments are guaranteed to provide profits, as you can also make a loss. In this video, we shall cover the following topics: types of traders, market participants, buying and selling, what is spread, long versus short, how to use shorts, and lastly,
The 5-question quiz.
and we'll test your knowledge.
Types of traders.
As a trader, you'll come into contact with various individuals and bodies, and in some cases need their services to gain access to the markets. In this section, we'll look at these market participants, their functions, and their motivations, and importantly, your relationship with them. There are two main types of traders that I'd like you to focus on: retail traders and brokers. Firstly, we'll look into retail traders. Retail traders. The term retail trader or retail investor generally means a private individual who buys and sells financial instruments using a personal account, not on behalf of an organisation. This will most likely probably be you. Retail traders generally deal in relatively small sizes, often in their spare time. Scalping. A scalper is an individual who makes dozens or hundreds of trades per day in an attempt to scalp a small profit from each trade by exploiting the bid and ask spread. Momentum trading. Momentum traders seek stocks that are moving significantly in one direction in high volume. These traders attempt to ride the momentum to the desired profit. Technical trading. Technical traders focus on charts and graphs. They analyze lines on stock or index graphs for signs of convergence or divergence that might indicate buy or sell signals. Fundamental trading. Fundamentalists trade companies based on fundamental analysis, which examines corporate events, particularly actual or anticipated earnings reports, stock splits, reorganizations, or acquisitions. Swing trading. Swing traders are fundamental traders who hold their positions longer than a single day. Most fundamentalists are really swing trading, since changes in corporate fundamentalists typically require several days or even weeks to produce a price movement sufficient for the trader to claim a reasonable profit. Now, that was retail traders. Let's look at brokers. As a retail trader, unfortunately, you can't just stroll into your local stock exchange and start dealing in shares. To buy or sell in the stock market and other financial markets, you'll generally need an authorized broker to act on your behalf. You may be picturing a bowler hatted city gentleman, but in fact it's more likely to be a company that provides an online trading platform. A broker can be either a firm or an individual and may offer the following: full service, actively managing your investment and providing personal advice; advisory management, providing recommendations but leaving the final decision up to you; education only dealings, simply carrying out your instruction to trade on demand. Now, it's important to note, the greater the input, the higher the fee that the broker may charge. Now, let's think about what type of broker a new trader should use. A full service. B, advisory management. C, execution only. Or D, any of the above. The correct answer is D, any of the above. It simply depends on the individual's skill set. A full service broker could guide a novice trader, potentially selecting more profitable trades with a significant cost. The advisory management service provides some support for a lower fee. However, the client must still take responsibility for their portfolio. So an execution only broker might be better value for traders willing and able to make their own decisions. Bear in mind that there are still costs associated with execution only trading, such as spreads, commissions, and financial charges. Types of traders. Section recap. Retail traders are private individuals who buy and sell financial instruments using a personal account. A broker is an authorized intermediary who executes trades on your behalf and may also give you advice. An exchange has a central physical location where brokers and dealers come together to buy and sell. OTC, over the counter. Markets are traded via a virtual network of brokers and dealers.
Market participants.
Market participants are market makers, institutional traders, high frequency traders. Market makers. Suppose you want to buy a particular financial instrument, but nobody is selling. Fortunately, this situation is unusual. There's generally a party who will take the other side of your trade, and is often a market maker, otherwise known as a liquidity provider. Market makers help keep the markets moving smoothly. A market maker is a firm or individual that holds an inventory of a particular security and quotes continuous prices to buyers and sellers. So if you place an order that goes through a market maker, it either deals from its own holding or seeks another party's order to offset yours. This happens electronically and almost instantaneously. Most market makers operate within exchanges, so your broker will transact with them on your behalf. The other market makers you're likely to deal with directly are forex trading firms which offer clients the facility to buy or sell currencies over the counter. Institutional investors or traders are organizations that deal in the financial markets, generally on a much larger scale than retail traders. As a retail trader, you may have little contact with these institutions, but it's useful to be aware of their activities. Institutional traders manage pools of money on behalf of individual investors. This means they sometimes make trades of a magnitude such that they influence market price movements, particularly in shares. Institutional traders include banks, life insurance companies, pension funds, mutual funds, and hedge funds. The large size of these institutional traders' positions means that they can sometimes receive benefits such as reduced commission rates. High frequency trading. The development of ever more sophisticated technology has given birth to a specialized kind of institutional trading, known as high frequency trading, HFT. HFT uses computers to automatically apply trading strategies and algorithms, finding and exploiting patterns, trends, and tiny fluctuations in the market. Instead of employing teams of analysts and traders, an HFT firm relies on technology that can make multiple trading decisions in a fraction of the time it takes the human brain. Market participants. Section recap. A market maker provides liquidity by holding an inventory of a particular security and quoting continuous prices to buyers and sellers. Institutional traders manage large pools of money and trade the financial markets on behalf of an individual investor. High-frequency trading uses technology to apply algorithms, placing vast volumes of ultra-short-term trades and capitalizing on brief market fluctuations. These are also known as HFT.
Buying and selling.
As the saying goes, it takes two sides to make a market. And those two sides are: buyers believe an asset's value is likely to rise, also known as bulls. Sellers believe an asset's value is set to fall, also known as bears. Demand and supply is interlinked with buying and selling within the financial markets. Which way would you expect levels of supply and demand to push the share prices in the following scenarios? Company X releases annual results showing a decline in performance. A. Share prices rise. Or B. Share prices fall. The correct answer is B. Share prices fall. Political instability in a precious metal producing region threatens supply. A. Price of precious metal rises. Or B. Price of precious metal falls. The correct answer is B. The price of precious metal falls. The British government announces policies designed to depreciate the pound. A. USD as GBP price rises. Or B. USD GBP price falls. The correct answer is A. The pound will tend to become less attractive to investors, increasing relative demand for the dollar and lifting the price of the USD GBP pair.
What is spread?
The spread is known as the gap between the bid and ask prices. This occurs due to buyers and sellers having different views regarding the value of an asset. Bid price is the price you will receive as the seller, and the ask price is the price you will pay as a buyer. So why do different prices apply for buyers and sellers? The gap between the bid and ask prices occurs because buyers and sellers often have opposing views regarding the value of an asset. The bid price is the highest price at which a buyer is prepared to buy. The ask price is the lowest price for which a seller is willing to sell. The spread may also incorporate a broker fee for handling the trade. The broker quotes clients a price slightly lower than the fundamental bid price or slightly higher than the ask price, keeping the difference to cover their costs. Spread. Section recap. A tighter, smaller spread makes it easy for you to profit if the market moves in your favour. The spread is affected by an asset's liquidity and also by the value of any dealing fees. In OTC markets, a range of prices are available and you can shop around for the best broker rates.
Long versus short.
Trading by buying an asset is called going long, while selling is going short. To open a short trade, you sell an asset whose value you expect to decline. To close, you buy it back, also known as covering. If you can now buy the asset at a lower price, you pocket the difference. If an asset's value increases, short sellers will lose money while traders with long positions profit. In order to sell an asset you don't own, you must first be able to borrow it from a lender. You can be called away from a short trade if the lender needs to reclaim the asset you've borrowed. If you borrow shares to sell short, you will need to compensate the lender for any dividends or other corporate actions announced during the borrowing period.
How to use shorts.
Let's look at some types of shorts. Speculation, hedging, ways to short sell. Speculation. If you opened a speculative short trade, your intention would be to profit from a potential downturn in the market. Speculative short selling enables traders to stay active even in bearish markets. However, trading in this way is associated with a higher level of risk. Note, your loss is theoretically unlimited, so please be cautious. Assume you sell 10 shares short at a price of 100 pence. Your maximum profit is £100 if the stock falls to zero. However, if the price rises to say 400 pence, your loss is a painful £300 and may continue to increase indefinitely should the stock continue to rise. There is no limit to how high the price might go. Hedging. While speculators take on risk, in contrast, hedging is seen as a more risk-averse approach. Taking a short position is a common strategy to offset or hedge the risk of adverse price movements in long positions you hold. In brief, the idea is that if your long position makes a loss, your short position will make a profit to compensate. For example, if you own a selection of stocks from the S&P 500, you might take a short position on the S&P 500 index as a whole to offset any potential loss should the market fall. You will still see a drop in your share portfolio, however, your short position on the index itself will help reduce the overall loss. Hedging can be seen as a form of insurance, however it has a cost. If your long position makes a profit, the short hedge will normally make a loss that reduces it. For many traders, the safety net offered by the hedge makes this worthwhile. In practice, retail traders may find it difficult finding a broker who offers short trading services to private investors. However, there are a number of derivative products you can short on, such as options, futures, CFD trading and spread betting, which is only in the UK. Short section recap. Speculating. Traders may go short on potential market movements, which is very high risk. Hedging. Traders aim to hedge long positions for short as such form of insurance to diversify their risk. Risk is theoretically unlimited when you go short. Derivatives are available as an alternative to going short through a broker.
Test your knowledge. The 5-question quiz.
Now, it's time to test your knowledge and put what you've learned within this video to the test. First question. Shares of Upskill plc are trading at 1,000 pence. You borrow 25 shares of Upskill plc from your stockbroker to short sell, and are credited with £250 as a result. After opening your short trade, the price of Upskill plc falls to 700 pence, at which point you decide to cover your position. Ignoring any charges or commission from the broker, how much profit or loss have you made in this scenario? A. £150 profit, B. £75 profit, C. £75 loss, or D. £200 loss. Ready for the answer? B. £75 profit. You made £250 from opening the trade, then spent 700 pence times 25, which is equal to 17,500 pence, or equivalent to £175 to cover your position, meaning your profit was £75. Question 2. If company Upskill reports an annual profit of £154 million, but most analysts were expecting a figure of £250 million, how would you expect levels of supply and demand to affect the price of its shares? A. Share price rises. B. Share price stays the same. Or C. Share price falls. Ready for the answer? C. Share price falls. Despite company Upskill publishing a healthy profit, it wasn't as large as the market predicted. This is likely to make the shares less attractive to investors, triggering a sell-off. The increase in the supply of shares on the market will cause the price to slump. Question 3. As a trader, why might a tight spread be seen as advantageous? A. The tighter the spread, the quicker you can profit if the market moves in your favour. B. The tighter the spread, the less it costs to buy shares. C. The tighter the spread, the more money you need to pay your broker. Ready for the answer? A. The tighter the spread, the quicker you can profit if the market moves in your favour. The reason for this is the closer the spread is, the less the market needs to move to break even on your trade. Question 4. If you sell 200 shares short at 5,000 pence, what is the maximum amount of money you could lose, ignoring any charges or commission? A. £10,000. B. Unlimited. C. £20,000. Ready for the answer? It's B. Unlimited. The reason for this is when you short sell, your losses could technically be unlimited as the share price could keep rising indefinitely. Question 5. Broker X provides recommendations on investment opportunities, however leaves the final decision up to their client. What kind of service are they offering? A. Advisory management. B. Full service. C. Execution only. Ready for the answer? It's A. Advisory management. A full service broker will actively manage a client's investments and provide personal advice, while an execution only broker will simply carry out a client's instruction to trade on demand. Well done, you've completed the quiz.